With the government announcing 10,000 new spots under the First Home Loan Deposit Scheme in the latest federal budget, I thought now was the perfect time to make a video explaining to you exactly how this scheme works and the new criteria that you need to meet in order to access the new tranche of 10,000 spots. As always, I'm also going to give you my opinion on the scheme and let you know whether or not I think it should fit into your financial strategy. Hello guys, Brad here from The Guided Investor. Welcome back to the channel for another video. If you're new here, consider hitting that subscribe button because I post regular videos about how you can do more with your money. And today we are talking about the 10,000 new spots under the First Home Loan Deposit Scheme. In a nutshell, this scheme is built around helping first home buyers get into the property market with a small deposit and without paying lender's mortgage insurance. Ordinarily, if you have less than a 20% deposit plus costs, then you need to pay an additional fee called lender's mortgage insurance or LMI. And now, even though LMI is called insurance, it does nothing to protect you. It's insurance which protects the bank because they see you as a high risk because you've got a high level of borrowing. LMI can be a significant cost and it's normally financed into your loan. So under the First Home Loan Deposit Scheme, you can potentially save up to $10,000 in LMI costs. The minimum deposit you need under the First Home Loan Deposit Scheme is 5% plus costs. Now this may vary a little bit depending on the individual lender's criteria, but in general it's 5%. So for example, if you're going to buy a $400,000 house, 5% is $20,000 of that. And the idea is if you have 5%, the government will guarantee 15% and therefore you don't pay that lender's mortgage insurance. Now I've mentioned plus costs a number of times and this is probably worth clarifying. So when you buy a house, it's not just the down payment or the deposit that you need. You need money to also cover the costs associated with buying the property. So that's things like settlement fees, building and pest inspection, adjustments to shire and water rates and things like that. The biggest cost is normally stamp duty, but as a first home buyer, you can get a stamp duty exemption if you limit your purchase price to the allowable amount. Now the allowable amount varies from state to state, so have a look at your individual state as to the maximum purchase price you can buy as a first home buyer without paying stamp duty. So in order to be able to buy a house under the First Home Loan Deposit Scheme, you need that 5% plus those costs. Now, if you go through a mortgage broker or even if you go direct through a lender, they should be able to give you a schedule of all the costs involved in purchasing a property given your specific property purchase price. Now, here's the catch. When the scheme was first introduced at the beginning of 2020, you could use this scheme to buy an established home. However, under the new 10,000 spots, this can only be used for a new home purchase, and they're dubbing this the First Home Loan Deposit Scheme New Home Guarantee. I must admit, I was disappointed when I heard of this change. Personally, I don't think first home buyers should be buying a brand new home, and the reason is because they have a limited budget, and that budget is best used to put more value into the land and less value into the house, which is a luxury item. Because at the end of the day, it's the land that's going to appreciate in value and the house will depreciate in value. Now, I've done a video on this previously explaining it in detail and I'll link that in the description box below. I can understand why the government made this change because at the end of the day, they're trying to stimulate the economy and they want first home buyers to pump money into the building construction industry with new home builds. But I'm looking at this from your perspective, and I don't believe it's the best move for your personal financial situation. In order for the house to be classified as a new home, it needs to be one of the following: a newly constructed dwelling, an off-the-plan dwelling, a house and land package, or land and a separate contract to build a new home. There are other eligibility criteria that you also need to meet in order to access the First Home Loan Deposit Scheme New Home Guarantee, and they are as follows. An income test. As a single person, you must earn less than $125,000 per annum, and as a couple, your combined income must be less than $200,000 per annum. To prove this, you'll need to show your notice of assessment for the previous financial year. The prior ownership test, you can't have owned a property or an interest in a property previously. You must be a genuine first home buyer. The citizenship test, you must be an Australian citizen to access this scheme. If you're purchasing with someone else, you both need to be Australian citizens. Having only a permanent residency is not sufficient. Minimum age, so you need to be at least 18 years old. Owner-occupied requirements. As with most of the first home buyer benefits, you need to move into the house within 6 months of purchase. However, there is an additional requirement under the first home loan deposit scheme, and that is you need to continue living in the property while there is still a guarantee under this scheme. This means you need to get your loan down to an 80% loan to value ratio before you can move out and treat the property as an investment. If you don't, you'll need to pay the LMI that was otherwise would have been applied. And a property price cap. So the value of the property you purchase must not exceed the allowable price cap limit. These limits have been changed for this new tranche of spots and vary depending on the region of your property. I'll put up a table now which outlines the new relevant limits. If you're eligible for the scheme, your lender will apply for the scheme on your behalf. You can't actually apply directly. And there is a panel of about 27 lenders that are eligible for this scheme, and they've all been allocated a certain number of spots. So once their spots are gone, then the scheme is closed off under that lender. Just bear in mind, this scheme is not the only way to avoid lender's mortgage insurance. Aside from saving up a 20% deposit, you can also avoid LMI using a guarantor that you source yourself, or using a government lender like Keystart. Now, both of these things come with their own set of considerations that you need to make before you go down that path. Another benefit of this scheme, other than saving LMI, is that you're going to get the best interest rate that the lender has available. And the reason is because if you have more than 80% borrowings on your property, you're considered high risk, and therefore, in addition to charging your lender's mortgage insurance, the lenders will want a higher interest rate from you to compensate them for that higher risk. With this scheme, you're going to get the best rate possible because you're considered a lower risk. So what are my thoughts on the first home loan deposit scheme new home guarantee? Well, as I already touched on, I don't personally believe that first home buyers should be buying a brand new house because at the end of the day, this is a luxury item and not the best way to build your wealth foundation. It's a bit like when you first get your license, you really shouldn't buy a brand new car because there's nothing wrong with a slightly older car with a few kilometers on it. If you do have your heart set on building, then sure, this scheme can help you. I really hate paying LMI because this is an unnecessary expense, and this scheme is a way for you to be able to avoid LMI. However, nothing beats good old-fashioned savings. I'm a big believer that equity creates security. The more equity you have in your property, the more secure your financial situation is. Because at the end of the day, property prices are out of your control. And if property prices were to fall, you could leave yourself in a situation where the value of the loan exceeds the value of the property. And if you need to sell for some reason, this becomes a real issue because you're left with residual debt and no asset. In addition to this, the higher your loan balance is, the more demanding it's going to be on your cash flow because the higher your repayments are going to be. And you're also going to leave yourself more susceptible to rising interest rate risks because at the end of the day, if you have a high loan balance and interest rates rise, this is going to eat further and further and further into your cash flow, leaving less available cash flow in order to build wealth. So in a perfect world, I would like to see you save up 20% deposits plus costs before buying your first house. Now, that for me is the Goldilocks situation, but I do understand that there are a lot of people that want to get into the property market sooner. And for you eager beavers, the ones that want to build, this scheme of course can help. So for me personally, I wouldn't use this scheme because one, I don't think buying a brand new house for your first home is the best way to set up your wealth foundation. And two, nothing beats good old-fashioned savings. But that's it for me today, guys. Thanks a lot for watching. I hope you liked this video. If you did, please give it a thumbs up and I will see you guys in the next one.